Last year, almost everyone, including this channel, predicted Melbourne property would grow 5 to 6% in 2026. It didn't. Rates went up, not down, and Melbourne is now staring down its sharpest property downturn in years. So what actually happened? What are experts now saying for 2027? And is this correction a buying opportunity or a falling knife? Stick around because this is the most important Melbourne property update this channel has produced. Let's start with the reversal nobody saw coming. Through the first half of 2026, the Reserve Bank of Australia delivered 3 consecutive rate rises, not cuts, taking the cash rate to 4.35%. 3 hikes, not the cuts the market was pricing in 12 months ago. Then came the federal budget in May. It scrapped negative gearing on established properties altogether, restricting it to newly built homes only, effective from July 2027. It also replaced the 50% capital gains tax discount with an indexed cost base and a 30% minimum tax rate on gains. Existing investors were grandfathered in, so nothing changes for properties already held. But new investor demand for existing housing stock, that's been reshaped at the structural level. The result? Melbourne dwelling values haven't just stalled, they've gone backward. Values fell 0.8% in the most recent month alone, down 2.3% over the quarter, and sitting around 3% below the market's earlier peak. Annual growth has been squeezed to just 0.5%. This isn't the gentle plateau story from a year ago. This is an active decline. Let's talk numbers because this is where it gets real. Melbourne's median dwelling value now sits at approximately $812,000. Houses carry a median of around $958,000, down close to 1% in a single month and almost 3% over the quarter. Units are more resilient, sitting near $637,000, down a more modest 0.4% monthly. Here's the twist headlines keep getting wrong. Yes, Brisbane, Adelaide, and Perth have technically overtaken Melbourne on median all-dwellings price. But that's partly a statistical illusion. Melbourne has roughly double the proportion of units compared to those cities, which drags its blended median down. Look at houses specifically, and Melbourne's gap to those growth cities is now the widest it has been in years. And the cooling isn't subtle. Auction clearance rates, which sat above 70% through parts of 2025, have slumped into the low to mid-50s, with some weekends dipping into the high 40s. One recent weekend recorded a year low of just under 56%, well inside what property economists consider firmly buyer's market territory. Estimated sales volumes are down more than 14% year-on-year, one of the steepest falls of any capital. Stock on the market has climbed, properties are sitting longer before selling, and past-in results are becoming far more common at the pointy end of the market. Buyers now have real choice, real time, and real leverage at the negotiating table, something that hasn't been true in Melbourne for a long while. So what does FY 2027 actually look like? Domain's official forecast, finalized in June 2026, predicts Melbourne house prices could fall between 4 and 8% over the year to June 2027, the steepest projected decline of any Australian capital. Under that scenario, Melbourne's median house price could slide below $1 million for the first time since 2021. Units are forecast to hold up far better, with falls contained to somewhere between 1 and 3%. But here's where forecasters genuinely disagree, and it matters. Commonwealth Bank takes a notably softer view, estimating the combined effect of higher rates and the tax reforms will only shave around 3% off Melbourne dwelling prices through 2026, with growth returning nationally by 2027. Westpac, on the other hand, is the most bearish of the majors on rates, still flagging the possibility of a fourth hike toward 4.85%, which would deepen any downturn further. NAB and ANZ currently expect the RBA to hold. That spread between banks, some seeing a shallow dip, others bracing for a deeper fall, comes down almost entirely to one variable: when and how fast the RBA eventually starts cutting. Now, why is Melbourne actually falling rather than just flatlining? Three forces are compounding. First, higher rates have materially cut borrowing capacity. Every rate rise pushes serviceability tests higher, shrinking what buyers can actually bid. Second, the negative gearing and capital gains tax changes hit investor demand specifically, since established properties, the bread and butter of most Melbourne investors, no longer offer the same tax-effective structure new buyers once relied on. Third, Victoria's land tax settings remain persistently high relative to other states, adding an extra layer of holding costs that other capitals simply don't carry. Layer consumer confidence on top of that, and you get a market where houses, the most leveraged, most investor-exposed asset class, are being hit hardest, while units are proving far more defensive. Now for the bull case, because this correction isn't purely bad news for everyone. As prices fall and rents keep climbing, at nearly 5% annual growth for both houses and units, Melbourne's gross rental yield has pushed up toward roughly 4%, among the highest of any capital city. For cash flow-focused investors, that's a meaningfully different equation than 12 months ago. The structural fundamentals, population growth, a world-class university sector, one of the most diversified state economies in the country, haven't disappeared. They're just being temporarily overridden by the rate cycle and policy shift. And Domain itself notes that a gradual recovery could begin from around the middle of 2027, once the RBA's first rate cut finally lands. So what does this mean suburb by suburb? Highly leveraged, investor-heavy pockets, typically the outer growth corridors where established housing dominates and negative gearing was the whole investment thesis, are the most exposed to further falls under this new tax and rate environment. By contrast, owner-occupier-heavy inner and middle ring suburbs tend to be more insulated, simply because fewer of those buyers are making decisions purely on tax structure. And this is the genuinely interesting shift. Unit-heavy inner suburbs like Fitzroy, Collingwood, and South Yarra, once framed mainly as affordable entry points, may now be one of the more defensive plays in the entire Melbourne market, precisely because units are forecast to fall so much less than houses. So what should you actually do with all this? If you're buying, a falling market with clearance rates in the 50s means genuine negotiating power for the first time in years. Longer days on market give you room to negotiate on price, terms, and settlement conditions that simply weren't available during the boom. But factor in that higher rates have already eaten into what you can borrow, so lower prices don't automatically mean more affordable. Run your numbers against today's serviceability buffers, not last year's. If you're selling, price realistically. Vendors still anchored to 2025 style growth expectations are the ones facing the longest campaigns and the most painful price reductions. 2027 is not a return to 2026's growth story, and overpricing into a genuine buyer's market risks a long, costly, confidence-eroding sale process. If you're investing, the negative gearing on established property playbook that worked for a decade is structurally weaker now. That doesn't mean investing stops making sense. It means the calculation has changed. Units, which are forecast to fall far less than houses, and new build stock that retains full negative gearing eligibility under the reformed rules, both deserve a serious second look alongside rising rental yields. And if you're a first home buyer, this is genuinely mixed. Falling prices help, but tighter lending standards, higher mortgage repayments, and the same serviceability buffers hitting everyone else partly cancel out the benefit of a cheaper purchase price. So the real opportunity depends heavily on your own borrowing capacity and deposit position, not just the headline number on a for sale sign. Of course, this forecast could shift again. If the RBA pivots to cuts sooner than the current mid-2027 expectation, the downturn could shallow out fast. If negative gearing changes get watered down or further grandfathered through the political process, investor demand for established property could partially recover. If population growth re-accelerates beyond current assumptions, that alone could offset much of the rate-driven weakness. And a global recession is the wild card that could cut either way, deepening the fall through weaker confidence or forcing the RBA's hand into earlier rate cuts that ultimately support prices. So here's the honest, revised call. Across the major forecasters, Melbourne house prices are projected to fall somewhere between 4 and 8% over FY 2027, with units far more contained, down roughly 1 to 3%. That's not a collapse, it's a correction, driven by a rare combination of rate hikes and structural tax reform arriving at the same time. Whether that turns into the buying opportunity of the cycle or a longer grind than anyone expects depends almost entirely on how fast the Reserve Bank moves next. What's the play for 2027? Hold, buy, or wait for the bottom? Drop it in the comments and make sure to subscribe for the next update the moment the RBA's next decision lands.